Hello students. Students, now welcome to this the second particular class of the compiler session. Now students, in this compiler class was the second one. The first particular part, students, I've already have done. The recording is done. I will be putting the link of the same in the description box. That is point number one. Secondly, students, the PDF file which I'm using for the compiler series, also students, I'm going to put it in this particular session which has been there. So I'll just put it across the same over here itself. Students, just now we have done with this May 22 attempt examination, and here I do have this particular question paper in front of me. I should say that this particular paper was relatively very easy paper. Obviously some students found it a bit lengthy, that is fine, but appears to be quite a relatively easy paper when I have to compare with the last 2 or 3 attempts wherein the papers was really on a difficult side. But this paper seems to be quite easy primarily, and in fact I must say that whatever we have covered in the last 2 or 3 marathon lecture that we have done day before yesterday or 2 or 3 days, majority of the things has been targeted, including our revision lectures, the bullet revision lectures that I have done it. So now it all depends upon how the students have fared it. At the end of the day, it's their practice which counts. The faculties majorly are doing, all the faculties do their best probably now, but it's up to the students how they would have executed this particular paper. But I must say that this particular paper, as compared to the last 3-4 attempts which we have seen for direct tax, this was really an easy one. Students, here we have got one question, a couple of questions which are there for the double taxation avoidance agreement and all, which I'm going to solve with all of you herein, so that you also get the feel of how the things has to be looked upon. So I'm going to solve those questions probably. Also the transfer pricing question which has been there, this is picked up from the module itself, the new question of the ICI module. So that is what has been picked up. So we'll be solving them, these questions, and then we'll take it forward. Let's start with our discussion then forward. So where is this file? So here is, students, again I am telling you the link of the first class. I'm going to put it in the description box so that the linking is there. So the last lecture, students, that we did in the first compiler series on the session, we have discussed the residential status as well as the section 9, the double taxation avoidance agreement and all. That is what we have discussed primarily in this regard. Now I'm going to take it forward towards our next topic, which is in respect of the double taxation avoidance agreement treaties. Let's begin with this one then. Now students, the treaty part of it, couple of important theory which, before we start with the question, let's first solve some couple of quick theoretical part, and then we will start with this particular practical part. So here in this context, students, double taxation avoidance agreement. Now, first and foremost thing, students, herein, just understand one particular part. In the DTAA, students, one thing which has been there could be 2 possible questions that could be there. You need to identify what exactly you are supposed to discuss in the examination. So there could be a situation wherein there is a SSE is a non-resident, is an NR. So the SSE is a non-resident, students. The first possibility, please identify the kind of the question which is there in the exam. And in the second case, the SSE is a resident. So this is precisely what would be the possibility which could be there so far as your examination is concerned. SSC can be a non-resident or an SSC can be a resident, as the case may be. Considering the fact that the SSC is a non-resident herein in this context, primarily, see here what will happen would be that in those questions, generally first of all, you will always have to look upon first section 9. So if whatever we have discussed, so if supposedly the income is deemed to accrue or arise in India, so therefore in this context, there are two types of question herein. Primarily, or may I just put it across this way? Section 9. Now in section 9, students, what will happen? Herein, there could be two scenarios. As per section 9, it is taxable or not taxable. So if not taxable, the answer will end over here itself. There is no further requirement of doing any other analysis. So no further analysis. Whereas if it is taxable, students, now then, if it is taxable, so accordingly they may try to, there are two things. Now 99% of the question, they will talk you about the tax liability. So tax liability as per the act. So you will do with the tax liability as per the act and the matter will get over here itself. And the second one would be 1% chances of the question could be that they can give you a question wherein they can have a situation where the income is the DTAA treaty provision. The DTAA treaty provision is also provided. The DTAA treaty provision is also provided, students. So if the DTAA treaty provision is also provided, students, over here, then in that situation, probably your answer in this case has to be like this. And the answer would be like what, students? That the act or the treaty, whichever is beneficial. Always keep this particular point in mind. Okay. That is the first and the aspect that you should always keep in mind in the examination question. Generally, we have seen that 99% question, they only talk about the tax liability as per the act. So, therefore, if supposedly they talk about treaty, they also give you for a non-resident something about the treaty. Then you will have to see what is a treaty provision, compare this treaty provision as per what is the position under the act, and then whichever is more beneficial to the SSC, that is what you are going to provide and you are going to conclude. Is that clear to all of you, students? Fine. So this is how you are supposed to deal with this. Now, if the SSC happens to be a resident, students, which is generally, which they have seen for the relief purpose. So what will happen is that, in this case, I have two things here in students now. Resident is there. And this resident has earned the foreign income. This resident, students, has earned foreign income. So, wherever this is the kind of or the nature of the question, wherein they are telling to all of you that there is also a resident who has earned the foreign income, then this is the case or the place wherein this entire concept of DTAA will come into picture. The treaty benefits and all this thing has to be looked upon carefully. The relief, the double taxation relief. So, now the foreign income in such case, the foreign income shall form part of just hold on here. There are two things that will be there. Just hold on, students. There is a DTAA, which is there or not. Double taxation of what is agreement. Either it could be yes or it could be no. If it is yes, then the treaty, students, the treaty herein may provide for two things. The income shall only, this is the key word, students, shall only be taxable. The income shall only be taxable in the country of source, which will be the foreign country. If this is the kind of a language that they've used, that the income shall only be taxable in the country of source, as I told you in the bracket, which is the foreign country, then in that particular case, students, be careful now. Then in that particular case, students, so if it is only to be taxed in the foreign country, students, if it is only to be taxed in the foreign country, then students, what will happen would be like this. Here, such income will not be part of the total income. However, such income will be considered in the working note, students. It will be considered in the working note for rate purpose. That is, rate purpose is, that is to calculate what is the effective rate of tax in India. What is the effective rate of tax to be applied on the Indian income? To be applied on the Indian income, students. So students, over here, if you see, again I am repeating this point very carefully, students, you should be very careful, because there is one question in the examination which I will make you go through it. We will go through this particular question also. You will find that there we will come across a situation where the income is only to be considered for rate purpose. To be considered for the rate purpose only. That is the limited impact so far as this particular provision is concerned, which implies that you will have only the Indian income as a part of a total income. You will have only the Indian income, students, as a part of a total income, and thereafter, students, you will calculate the tax liability till HEC, whatever it is, but the tax liability that will be calculated would be as per the effective rate. And the rate, for the purpose of determining the rate, you will then include the foreign income. For the purpose of determining the rate, you will then include what? The foreign income, and that's exactly what you are going to deal with this one. So students, this is how the things has to be considered over here, and that exactly is the point. So this is the situation that you should always keep in mind. So the income shall only be taxable in the country of source, so that is foreign income. Now come to the next particular part, students. Please come to the next particular part. Here, if the treaty exists, the income may also be considered in the resident country. Resident country means that is in India. So the income may also be considered in the resident country, which is India, students. Keep that in mind. So that is India. So in that particular situation, students, what will happen? Here, what will be the situation? You will include the foreign income. Include the foreign income over here. So the foreign income, students, would get included in the total income. In the total income, the foreign income would be included in total income. Calculate the tax liability. Calculate the tax liability till HEC. Ajita, I'm taking this one in English. I'm taking it in the YouTube, and in Hindi I will be doing it in the special class. So that's precisely what I'm doing it. So English I'm doing it in the YouTube, the compiler entire, and in Hindi I'm doing it in a special class. Okay. So calculate the tax liability, students, till the HEC. And thereafter, students, this is where the situation will be the game. Time, see, at night only I'm doing it. Today only I'm doing it at 8:15. Otherwise, generally you'll find at 10:30 at night. 10:30 at night. Okay, so that would be our timing. For the next 3 days, you will find at 10:30. Then definitely I will keep it update. I'll update this thing in my Telegram channel also about the timing in which we are going to start. In the Telegram channel, students, definitely it will be updated. Fine. But I should tell you that tomorrow at 10:30 again, Saturday, Sunday and Monday, the 3 days which I am going to take back to back would be at 10:30. Okay, so that is the point in which we are going to complete this one. Students, now let's have a look over here in this case. So calculate the tax liability till the HEC. Yes, Ajita, definitely. Do the revision, probably whatever we are doing it here, that all the practicals I'm also going to go. So you majorly do the revision of the practicals directly from here. And now only focus on the practical part. Less of, I'm doing also a bit of theory as well. I'm just going a bit slow. I'm just doing a bit of theory as well here. So as to just do a quick revision of the theoretical part and then directly the problems. So that is how the approach is. So that at least the students don't feel completely new to what we are doing it. So that is probably what I'm trying to deal with it. Okay. So now students, even so here you need to calculate the tax liability till the HEC. Okay, after including the foreign income in your total income, calculate the tax liability till HEC and thereafter provide the relief through the foreign tax credit. Now this was may attempt also, we will discuss the question also. So relief would be through the foreign tax credit. Through the foreign tax credit method. Now what is the foreign tax credit? Probably there is a way out to do a foreign tax credit. We will discuss that particular thing. But before that, let me in fact tell you about this particular part. Let's have a look. If there is no treaty, also, doesn't matter. Here the treatment would be at par. Treatment at par with this particular method. So whatever we have discussed in the case where there is a DTAA, what we do therein, we include the foreign income as a part of your total income. We include the foreign income, students, as a part of our total income, isn't it? And once that foreign income is included as a part of the total income, thereafter we calculate the tax liability till HEC. And after that we are giving the relief. And the relief is the foreign tax credit method. Same is also when there is no DTAA. So if there is no DTAA, there also we do the same thing. What is that? We will first include the foreign income as a part of our total income. And thereafter we will calculate the tax liability till HEC. Thereafter you will calculate the tax liability till HEC. And finally the relief would be given. The relief would be granted, and the relief would be granted through the foreign tax credit method. That is exactly how the things has to be looked upon, students. What question, students, we will do, and this was also targeted in the last attempt RTP. So the last attempt RTP, students, one question was there, And this is what was the question, last attempt RTP, which is December or I think May 22, one of the two RTPs. So we will do that question first, the RTP question, and thereafter. So this is your question which is there. Yeah, page number 466, and that is question number 422. Let's have a look. So examine in this context, students, the tax consequence. Examine the tax consequence, students. For the assessment year 22-23, in respect of fees for technical service received by Mr. Tom Sayer, a non-resident from Ganga Limited, an Indian company, in pursuance of an agreement approved by the central government. So students, this is a case of a non-resident. I already told you, again I am repeating this point, those who have just joined it, for all of them. If he is a non-resident, what did I told you? This is the RTP question. That's the reason why we discussed initially about a DTAA. I told you about the fact that if there is an SSE and he is a non-resident, you will have to see section 9. As per section 9, whether that income is taxable or not. Sorry. And if it is taxable, students, as per section 9, if it is taxable or not, if it is taxable, students, and not taxable, the matter will end. But if it is taxable, then students, 99% question only talks about the tax liability as per the Act. But in 1% cases, which we are discussing now in that case study, the DTAA treaty provision is also provided. So we will see what the treaty will provide. And then what did I say to you? Answer would be Act or the treaty, whichever is beneficial. Act or treaty, whichever is beneficial, is what we have to look into it for the non-resident. Okay. So this question that we are going to do it right now, this will have this particular application of this concept. So let's quickly run through this particular concept now over here. So in respect of FTS received by Mr. Tom Sayer, a non-resident from Ganga Limited, an Indian company, in pursuance of the agreement approved by the central government. Tell me one thing. Non-resident receiving a fees for technical service income. A non-resident who is receiving the FTS income from whom? From an Indian company. Just in the first class, we have discussed that this income is deemed to accrue or rise in India. In the very first class, students, we have discussed that this particular income is deemed to accrue or rise in India. Isn't it? So in this case also the similar would be the positioning, wherein we are going to say that yes, in this case as well, the income will be deemed to accrue or rise in India. Isn't it? So therefore, yes, section 9, it is taxable. Let's have a look. If India has no DTAA with country A, so what will happen? If India does not have the DTAA with country A, students, can we therefore conclude safely that this particular FTS income will be taxable under the Act? Can we say so, students? If they are telling us over here that there is no DTAA, at all over here, students, can we therefore say that this particular income would be taxable only in India? Answer is yes, because obviously India being the source country, and definitely in that scenario will be taxing this particular income. Come to the next point, point number B. India has a DTAA with country A, which provides for the taxation of FTS at 5%. What did I told you? If there is a DTAA, students, I told you that then the provision of the Act or the treaty, whichever is more beneficial, has to be considered. So if you go as per the Act, then the rate of tax is 10%. The 115A rate for the FTS income, 115A rate for the FTS income is 10%. Whereas over here, the rate that has been provided to us is 5%. So which is more beneficial? 5%. So accordingly, we will go as per 5%. But students, don't you think that there is one procedural formality that needs to be complied with? Do you all agree to this one? Ajita, what is the procedural formality that needs to be complied with over here? One important procedural formality, students, needs to be complied with over here. And what is that? By the way, students, one more thing. In the description box, again I am telling you, I will be putting the PDF of this particular file. Also, students, the theory of the non-resident taxation, the theoretical part of the NR taxation also, one video is there. That video also I'll put it in this description box itself. Okay, because obviously in this compiler you will not find the theory of the non-resident taxation. So, but as you all are aware, there is a specific theory in the new course which is there. So I'll put that particular video link in the description box. Okay, right now it is not there, but it will be there, reflected by tomorrow's video or so. So now, students, you tell me in this regard. One procedural, as you all say, sir, 5% is the rate. Yes, 5% is the rate. But more importantly, students, over here now, if it is a 5% rate of tax, that has to be considered. More importantly, students, now that we need to talk about is this, that yes, there is a concept of TRC. Are you aware of TRC? TRC is the tax residency certificate. You may be aware of this particular term. And the TRC, as per the TRC requirement, students, if a particular treaty benefit has to be availed by a non-resident, that non-resident has to furnish the tax residency certificate to the payer of the amount in India, so as to get the benefit of the treaty. Very clearly, students, who is the person who can invoke the treaty? The person who can invoke the treaty is, he has to be a resident of one of the two countries. Bilkul. He has to be a resident of one of the two countries. Only then, students, only then the treaty can be invoked. So this is what it is to be considered over here in this regard. Point number C. India has a DTAA with country A, which provides for taxation of FTS at 15%. So treaty says 15%, Act says 10%. Which is more beneficial? It is a 10% rate. So we will go as per the 10% rate, and accordingly in that case, students, the Act rate of 10% is more beneficial. So I'll go with that. Now, if you see below this particular paragraph over here, the technical services are utilized by Ganga Limited for its business in Calcutta. Assume that Tom Sayer is a resident of country A and he has no fixed place of profession in India. Students, in the first class itself, we have discussed this particular point also, which is getting repeated over here. So, in respect of three incomes, interest, royalty and FTS income, we are not bothered whether the non-resident has rendered the services in India or not. Similarly, we are also not bothered whether the non-resident has any PE or any fixed place of business in India or not. These are the irrelevant tests for all of us in this context. These are the irrelevant test, students, in this context. And that is the reason why, students, that is the reason why, if you see over here, what we will find it, the technical services are utilized by Ganga Limited for its business in Calcutta. Assume that Tom Sayer is a resident of country A and he has no fixed place of his profession in India. So in that particular situation, students, we will say the answer will not change. The answer will not change because this income is not dependent upon, the chargeability of this income under the Act is not dependent upon whether the non-resident has rendered the services in India, whether the non-resident has got a PE or a fixed place of business in India. These are the irrelevant criteria. Would your answer change if he has a fixed place of his profession in India and he renders technical service through that place? Yes, to that the answer will change, because, students, if you know, there is that 44DA that will come into play. Up till now we were talking about 115A, but the moment you say that this particular person has a fixed place of profession or a fixed place or permanent establishment in India through which he is providing the technical service, then the assessment of that technical service fees will not be under 115A. That assessment will then be under section 44DA. So this is what it would be, students, in this case. So in that scenario, students, here if you see, just have a look over here. If Mr. if Mr. Tom Sayer has a fixed place of profession in India and he renders technical service through the fixed place of profession, that by virtue of section 44DA, such income by way of FTS received by Tom Sayer from Ganga Limited India would be computed under the head PGBP. Would be computed under the head PGBP in accordance with the provision of the Income Tax Act 1961. Since technical services are provided from a fixed place of profession situated in India and the FTS is received from Indian concern and is effectively connected with such fixed place of profession. So as I told you that if you have got a P in India and the services are effectively connected with that particular P in India, then we have said already that the taxability will arise. Students, then the taxability will arise under section 44DA and not under section 115A. And if it is under 44DA, students, then we get the deduction of the expenditure in respect of the P. So only the expenditure which is wholly and exclusively in respect of the P, only for that the deduction would be allowed, which implies that if supposingly there is any common expenditure, students, if there is any common expenditure, then please tell me in respect of such common expenditure, do you get any deduction of the expenditure? And the answer is no. You don't get the deduction of the expenditure if it is merely a common expenditure. Is that clear to all of you, students? Fine. So therefore, this is what it is. So no deduction would, however, be allowed in respect of any expenditure or allowance which is not wholly and exclusively incurred for the fixed place of profession in India. Okay. And Mr. Tom Sayer is required to keep. See, these are procedural parts, students. I've already have covered this. So just quickly read this A, B, and C over here so that you are done with this one, and then I'll just move to the next particular area. Quickly, students. Okay, friends, through with this one, let's now proceed further. So, students, now then, I'll come to this particular part now. Now, students, here in this attempt question, May 22 attempt question, that is precisely the problem. I always keep in telling you about this particular concept, and that is where I think students. Okay, Ajita, the flow would be that we are doing non-resident taxation, then transfer pricing. That first 30 marks is what is the target to be covered. Once that is done, then we will go to PGBP. So this is the flow in which we will be doing it. So I think tonight also this NR will happen. Then tomorrow maybe equalization, maybe whatever is the practical problems are there. And maybe we will be in a position to start tomorrow night with transfer pricing question. Then maybe 2 more sessions with transfer pricing. And once that is done, theory I have already told. Theory I am giving it in the description box. The link of the lecture I am giving in the description box of the theory, the revision which I have already have done it. So you can please refer that particular lecture from there. Okay, because theory there is no question over here, technically speaking. And last is thereafter we will move to PGP. So all the high stake chapters I'm taking first, so that students can get good amount of practice time also for themselves. Okay. Perfect, not an issue. You can also try to recollect, because I think you have done it once, so you can also recall it. But yes, I'm just telling you that this is the flow in which we'll be doing it. Okay. Thereafter, MAT will be done, alternate tax regime, taxation of dividend, surrogate taxes, capital gains. So that is, I'll give you the list. Once I start with the PGBP, I'll tell you what would be the next topic, so that you people are prepared for this one. But after transfer pricing is done, thereafter we'll move to PGBP. Fine, students. Now let's look upon the question. Now, what is the situation that has happened, students, in this attempt also? Students, see what is the scenario. If you see this attempt question paper, I'll just show you this attempt question paper now, May 22, so that you can appreciate the seriousness of this question that they've targeted. I am not discussing this full question because many May 22 students are very curious to know about it. There is a separate decode question which is there, a session which we are doing it on 3rd. But still, because I'm there in this topic, therefore I'm discussing this particular area of the question which is asked in this May 22 attempt. Here it is. See here, students. Mr. Chetan, an Indian citizen aged 51 years, left India on 1st April 2018 to settle in country Y. But owing to some personal unavoidable circumstances, he returned back to India permanently. Now, in my first lecture, students, we were discussing that an Indian citizen or a person of Indian origin who is returning India for visit purpose. Then there was this, you remember? Then we had this in 182 days is what has to be seen. Then the second basic test will not be considered at all. Only 182 days is what needs to be seen. Yes, we discussed the amendment also of Finance Act 2020, where the total income excluding the foreign income is more than rupees 15 lakhs. So that way we have discussed. Then the second basic condition will be introduced with 120 days in the current previous year and last 4 preceding previous year to be 365 days minimum. So that is one thing we have discussed. But this question is for not visit purpose. He is permanently coming back in India. So the special provision that was applicable for those Indian citizen or person of Indian origin who is returning in India for visit purpose, that special provision would not be applicable. And instead the normal provision would be applicable. And what is the normal provision? The basic test would be the 2 basic test. That is 182 days in the current previous year and 60 days in the current previous year and 365 days in the last 4 preceding previous year. That is what was the scenario, isn't it? So here, students, if you see in this context, permanently he is coming back in India and he is coming on 1st of June itself. So obviously it implies that 182 days condition is satisfied. So he is a resident in India. Now he has residential property in country Y, from which he earned income of $25,000 for the year ended 31st March 2022. This is what I was talking about it. They are giving the foreign income in US dollar. This is how it should always be. In fact, I was telling you also in our question bank also we have this question of Mr. Patel, wherein that Mr. Patel had this particular foreign currency in that. So therefore the reference of foreign currency becomes mandatory, students, in this regard, isn't it? Now the question is, how do we do the conversion rate? Now we will see this question right now, Miss Amruta question. This is the problem. Miss Amruta question, there they have already given that the foreign currency should be converted in this particular INR. How do we know? But now we will know that in this case, with $25,000, students, for the year ended 31st March 2022, please have a look to the exchange rate. Students, there are 3 exchange rate that is given to all of us. Can you tell me which is the exchange rate that I need to look into it? There are 3 exchange rate that has been given to us in respect of the residential house property. We have got 3 exchange rate. So therefore, they have given to us the exchange rate as on 1st of April 2021, 31st March 2022 and 10th of May 2022. A classic question, students. So here, students, and this is the game, Mr. Patel question. This is our Mr. Patel question. I am so happy that this particular question came, because I can say that this was our only booklet, is the booklet wherein this question was covered. There is absolutely no other particular book where this question has been covered. And I will show you Mr. Patel question in our compiler series itself. It is already there. And how do we do the conversion? I will also show you that itself. So if you see over here, students, the house property income has to be converted into this 25,000 into what? Into 75,000. So house property income, PGBP income. For that, the conversion rate as on the last day of the previous year is what has to be applied. As on the last day of the previous year is what has to be applied, students, over here. And that exactly is the point. 31st March. Yes, Ajita. The last day of the previous year is what has to be applied. So accordingly, you do the conversion. But there are some other particular income for which there is some other conversion rate as per rule number 115. That is not the point of the consideration. Now, if you see, the tax paid was on 10th of May 2022 from his bank account in India. Means he has paid the tax. Students, he has paid the tax in the foreign country. Students, he has paid the tax in the foreign country. When he has paid the tax in the foreign country? On 10th of May. On 10th of May, he has paid the tax in the foreign country, students. So he is eligible for basic exemption limit of $8,000, and on the balance income, he paid income tax at 20% in country Y. The tax was paid on 10th of May 2022 from his bank account in India. Fair enough. Now, in this context, students, his income from business in India is 5 lakh for the year ended 31st March 2022. That is what it is. But the point right now is that we will discuss this particular question in length, in breadth right now through Mr. Patel, and thereafter you will understand the nuances of this question. Let me in fact take you through to this one quickly now, to our compiler. See what is the situation. ICI old questions. Question 426 of Amruta. Now I'll show you the question that they have targeted up till now. And now I'll also show our Patel question, which we are going to solve. See here, Amruta is a resident individual. She has income from following sources. And the income is taxable income from sole proprietorship concern in Kochi is 50 lakhs. Share of profit from partnership firm in Chennai 30 lakhs. So share of profit from partnership firm, this is exempt. This is, by the way, A and B is only Indian income. C, point number C. Agricultural income from rubber estate in country A, with whom India does not have DTAA. Students, no DTAA is there with India. Now US dollar 70,000. Now US dollar has been given, but what these people have done? Assume $1 US equal to 64. So already the conversion factor has been given to you. There is no thrill at all further. But there in this May 22 attempt, they have given you 3 conversion rate and they were expecting you to apply the correct conversion rate. Is that clear to all of you students? So therefore here agriculture income from rubber estate. Yes, Ajita. It is also there. In the current year also I have put it across the chart book. Perfect. It is there in the chart book as well. Very true. So agriculture income from rubber estate in country A, with whom India does not have DTAA, shown 70,000. Now, is it exempt? Obviously no, because it's a foreign agricultural income. So there is no question of exemption. So this particular agricultural income, will it form part of my total income? Answer is yes. It will definitely form part of your total income. So no doubt about that. it will definitely form part of the total income, students. Okay, so therefore this is about the 70,000. Withholding tax on the above income is 10,500. What does it imply? It implies this is the tax that you have paid in the foreign country. Now students, can you tell me how much is the percentage of tax therefore in the foreign country? With 10,500 divided by 70,000, with 10,500 divided by 70,000, you will be getting the percentage of the tax that you have paid in the foreign country, which comes to around what, 15%? I suppose. So therefore, this is a tax that you have paid it in the foreign country. Now, if you see below that, 15%. So tax rate in the foreign country is 15%, which is very obvious from point number C. Point number D, which they are saying, is the brought forward business loss in country A was $10,000, which is not permitted to be set off against, the other income as per the law of that country. Please tell me one thing. This Miss Amruta, she is a resident in India. And the fact that she is a resident in India, students, now you can say, students, the fact that she is a resident in India, you all can say that her world income is taxable. Now, her world income would be assessable as per the provision of the Income Tax Act. Her world income would be assessable as per what? As per the provision of the Income Tax Act, and not what? And not what the other particular law has to say. Do you all agree to this one? The other particular law may say anything. But now, since we are assessing this particular income of Miss Amruta under the Act, because she is a resident, the assessment will be done in the manner which is provided under the Act. So, in the Act, do we give the set-off of the brought forward business loss? Answer is yes. And the fact that we give the set-off of the brought forward business loss, therefore, do we give the set-off of this particular loss of 10,000 into 64? Yes, we have to do this. Even if in the foreign country, it is not subject to the set-off. Even if in the foreign country, it may not be subject to a set-off. Now, please have a look over here, students. So, income from sole proprietorship concern in India is 50 lakhs. Share of profit from a partnership firm in India of rupees 30 lakhs is exempt. So this is nil. The share of profit from a partnership firm in India of rupees 30 lakhs, students, is exempt, which is nil. Isn't it? Now, after this, students, the business profit. Now, there is herein less the business loss in country A. The business loss in country A, students. The business loss in country A, students, $10,000 into rupees 64. So please have a look over here, students, in this context. The business loss in country A, students. Now, you tell me one thing over here, students. I have done the set-off of 6,40,000. Then there is an income from other sources, which is the agricultural income that you have earned in that country. That will be forming a part of the total income. That is what is going to form part of total income. Then you will calculate the GTI. There is no chapter 6A in this question. There is no chapter 6A, students, in this question, isn't it? And thereafter that there is a tax on the total income that has to be calculated. Now please be careful. 88,40,000, and she is a resident. By the way, we all know, being an individual as well, there is a surcharge more than 50 lakhs. So don't forget, because this is a step where I will say that many students will do a silly mistake. They somehow or the other will forget that the individual does have a surcharge element when the total income exceed more than rupees 50 lakhs. So herein there is a surcharge at the rate of 10%, which has been there on 50 lakhs surcharge which has been there. And accordingly, students, 2,46,450 is the amount of the surcharge on the tax portion, and you take the subtotal and finally the HEC at 4%, which is 108,438, and then you take the subtotal 28,19,388. 28,19,388. Take the Indian tax rate, which is the average rate. I think all of you are aware how to do that. The total income, the tax, which is still HEC. Yeah? Be careful. The Indian rate that you are calculating it primarily here is 28,19,388 till HEC divided by the total income of 88,40,000, which will give you finally the average rate of tax, which will give you finally the average rate of tax, which is 31.89%. Okay. Now, accordingly, now you have to compare. Be careful now. You will have to provide the relief. You will have to provide the relief in this case. The relief would be the rate which is lower of the two. So, which is the lower rate? The foreign rate is lower. And this relief has to be provided. This is a very important statement, students, I am making for all of you. This relief has to be provided on that portion of the foreign income, that portion of the net foreign income, you'll write, students, what? That portion of the net foreign income which was subject to double taxation. Which was subject to what? The double taxation. Yeah, Ajita. So the statement is very clear, because in this attempt also, students, I will just let you know one statement and I'll take you to the May 22 attempt paper. And then you will be in a position to decode what has to be done. So 15% would be on that portion of the net foreign income which was subject to double taxation. So obviously, students, if you see very carefully over here, 44,80,000 minus 6,40,000. And what is this 6,40,000? That portion of, because this 6,40,000 resulted into the dilution of the net of the foreign income, because this loss has resulted into the decrease in the foreign income as a part of my total income. So the net foreign income finally, on which form part of my total income, on which there was Indian tax liability calculated. What was the net particular foreign income which formed part of my total income, on which the Indian income tax liability was calculated? So the net foreign income was rupees 38,40,000. The net foreign income, students, is what? 38,40,000. How 38,40,000? 44,80,000, students, already you got it over here. 44,80,000 already you got it over here. And from this 44,80,000 you have reduced rupees 6,40,000. From this 44,80,000, students, you have reduced 6,40,000, which got you to 38,40,000. And once you got this 38,40,000, students, that 38,40,000 you have thereafter. This is your doubly tax income, and which is the rate that you have applied? 15%. And finally you have got the relief of 5,76,000, and the relief is from the tax liability till HEC, and finally the net amount is the tax payable. Now I should tell you, students, and be very careful. Aren't we doing the rounding off over here? So there is a rounding off calculation, students, that you can see it over here. This rounding off that you have to do carries half marks. Many of the students are not aware of this point. This nearest 10, and the rounding off, don't do nearest 100. The rounding off has to be done to nearest 10. And therefore, this rounding off has been done over here. I hope that every one of you are clear with this one now. Okay. We will discuss one more question, and then I will take you to the May 22 question on one particular part. Students, all of you, very quickly, will read this particular aspect. Read this question of Mr. Kalpesh. So students, if you have read it now, so let me take you through to this one now. So very quickly students, Mr. Kalpesh, who is of age of 56 years, a resident individual, furnishes the following particulars of income earned by him in India and country T for the previous year 21-22. India has not entered into a double taxation avoidance agreement with country T. So that is what it is. And thereafter, students, income from profession carried on in India is how much? Rupees 6 lakhs. Income from profession carried on in India is how much? Rupees 6 lakhs. Agricultural income in country T, students, is how much? 75,000. Obviously, this would be taxable in India also. Dividend from company A or from company incorporated in country T, students, is how much? 1,20,000. The dividend from a company incorporated in country T is how much? 1,20,000. Royalty income from a literary book from country T is how much? 4 lakhs. Now students, please understand this royalty income. In the first class I told you about certain royalty incomes like this is a copyright royalty, and therefore an Indian resident earning a copyright royalty, there is a deduction of 80 QQB that we all get it. There is a deduction of 80 QQB, students, that we all get it, isn't it? So that is one of the deduction of 80 QQB. That is what is allowed in this regard. So here this particular royalty income will be subject to deduction of 80 QQB. Okay. Now what about this expenditure? Whether this expenditure which has been incurred to earn the above royalty income, will that also be allowed as deduction? Why not? Even this particular expenditure which you have incurred for earning the above royalty income has to be allowed as deduction in this case. Has to be allowed as deduction, students, in this case. Because students, there is no special rate of tax that is applicable on such royalty income. Please understand one thing. If supposingly there is a special rate of tax that is applicable, then and only then there is a restriction or a prohibition of the deduction of the expenditure against the royalty income. Like the non-resident earning a royalty income, we have seen that that is assessable under 115A. And because it is accessible under 115A, therefore there was a special rate of tax of 10%. There was a special rate of tax of that 10% without any deduction of the expenditure. But then this particular royalty earned by a resident out of the copyright, this royalty being the royalty on account of the copyright, there is no special rate of tax whatsoever in this particular royalty income. And because that there is no special rate of tax in respect of such royalty income, accordingly, students, what we are going to say, that this particular 4 lakhs will be subject to the deduction of the expenditure. Not only that, it will be further be reduced by the Chapter 6A reduction of 80 QQB, and that will be 3 lakhs. By the way, students, I should tell you one important point over here. This attempt, May 22, there was no question. I have not seen. I have to go again relook the except in question number 1 for ATM, which was for dividend. There was in all the remaining section. I am not aware of MCQs, but descriptive question I have not seen any question on Chapter 6A, which makes very favorite November 22 attempt. Straight away Chapter 6A could be one of the most important area. Secondly, even the set-off chapter for November 22. These are the two important chapters right now itself, students, I am telling to all of you. Third topic, if you want to hear it from me, clubbing of income. These are the topics which I am outrightly telling to all of you. Fourth would be the capital gains, and in the capital gains, the partnership assessment. I am telling you straight away, students. November 22 attempt. So on and so forth. You'll say, sir, what about non-resident taxation transfer pricing? It is always come. So because 30 marks is allocated. So there is no such ifs and buts in this. Okay. So there is no thought. Don't even think of not doing it primarily, because 30 marks is allocated. So therefore that is the point. But rest of the topic I can outrightly say, students, going by what was the question which I've seen of today's paper. Anyways. Now students, business loss of country T, which is there. How much is that? 75,000. Now this 75,000, students, will that be allowed to be set off? Answer is yes. So this 75,000 of this particular business loss, will that be allowed to be set off? Yes, it will be allowed to be set off, students. Now after this, if you see, as per the income tax law of country T, business loss is not eligible for set off against any other income. The business loss, students, is not eligible for what? For set off against any other income, students. Now same thing like Amruta, same thing will be there. Here we are going to do the set off. Definitely we are going to do the set off. Whatever they say, we don't care. The rate of income tax in country T is how much? 20%. The rate of income tax in country T, students, is how much? 20%. Keep this particular point in mind. Now compute the total income and tax payable by Mr. Kalpesh in India for assessment year 22-23, assuming he satisfies all the conditions. Now students, what has happened? So students, even if there is no treaty, it doesn't matter. We will do the calculation in the same way as you always know how the calculation has to be done. So there is absolutely no issues on this. Please have a look, students. The business loss, I have done the set off. I have reduced the business loss. Even if in the country T, business loss set off is prohibited, but didn't I told you just now some time back that we have to assess the foreign income as per the manner which is laid down under the Act. If it is to be included in the total income of the resident, then the assessment also has to be in the manner laid down under the Act, and accordingly we will have to do the set off. If under the Act there is no prohibition or restriction of the set off, then definitely, students, we will have to do the set off. So that is what we do. Agriculture income, that is in country T, is it exempt in India? No. So that is one thing that we all know. So just a second. So students, over here if you see, agriculture income in country T not exempt under section 10(1). Dividend received from company incorporated in country T is 1,20,000. So that is also there. Royalty income from country T after so obviously students, this is, I think there is a this thing. Anyway, so royalty after the deduction of the expenditure, students. After deduction of the expenditure, so after deduction of the expenditure, it is 3,40,000. After deducting the expenditure, students, this is 3,40,000. So therefore, this I'll say 3,40,000. Okay, 3,40,000. And this was, I think, how much? 1,95,000. So therefore, now once you take the total, it becomes the GTI is at 1060. GTI is at 1060. Then on the royalty income, I get 3 lakh for the deduction. 3 lakh for the deduction. Total income is calculated of total income of 760. So I will only calculate the tax. Tax would be 64,500. HEC, no surcharge. HEC, and then after HEC, the total tax liability is how much? 64,080. And if you see the average rate that you do it in India, it is only 8.826%. And please compare this with the average rate of tax in country T, which comes to 20%. So the lower of the two is what finally would be taken into account. The lower of the two is what finally will be taken into account. That is what we will do it in this case, isn't it? So this is what we will have to take into account. Now, after the tax liability, we will give you the relief. From this tax liability, students, we will give you the relief. 8.826 is the qualifying rate. 8.826% is the qualifying rate. Again, I am writing the same thing. This credit has to be given on the basis of the eligible rate, and that eligible rate would be applied on the portion of I will keep on writing this portion of the net foreign income which is subject to double taxation. Double taxation would therefore imply means tax in the foreign country as well as that is tax in the India as well. That is tax in India as well. And when we talk about for taxation in India as well, students, what does it imply? It will imply that students, that foreign income, the net foreign income, students, will form part of the total income, and on that total income the tax liability is calculated. On that particular, the net foreign income, students, which is part of your total income on which the tax is applied, this is what is subject to tax in India. And then we will have to see what is subject to tax in the foreign country also. As I told you, students, it is the net, that portion of the foreign income on which the double taxation is applied, that portion only has to be considered by us. That portion only has to be considered by us. Did you all got this one, students? So now if you all see it over here, students, we always, now we come to know over here is this, that students, in this case, the royalty income from literary book from country T, the royalty income from literary book from country T, students, 4 lakhs. 4 lakhs is there. After this, now from this 60,000 was eliminated, and thereafter 3 lakh was eliminated. So how much of the royalty income became the part of the total income on which tax, Indian tax, was applied? So the royalty income which became the part of the total income on which the Indian tax was applied was 40,000. 3 lakhs was also the deduction. 60,000 was the expenditure deduction. So total 3,60,000 deduction from the 4 lakhs. So what is left is only 40,000 in the total income on which tax was being charged, isn't it? Thereafter you see over above, dividend from a company incorporated in country T is how much? 1,20,000. So this is there. So this is also 1,20,000 in entirety. Thereafter agricultural income in country T, 75,000 also will be considered. 75,000. Now business loss, 75,000. Now this has reduced or diluted. This is the net foreign income. So the set off of loss would also be considered. So therefore the net foreign income which finally became the part of the total income on which the Indian tax was applied was 1,60,000. So can I therefore say safely that the portion of foreign income which is tax in both the countries, the portion of the foreign income which is tax in both the countries is 1.6 lakhs. And on 1.6 lakh students, primarily what we will have to do on 1.6 lakh students, you can see it very carefully. The applicable rate is 8.826%, and that therefore gives you the credit of foreign tax rate of 14,122. 14,122, and the net amount is a tax which is payable. Is that clear to all of you, students? And now I will introduce for all of you one question of this examination. In this question of the examination, let's May 22 attempt. See, this is where students have found it uncomfortable because they have not done it. And if they have not done it, they will definitely find it uncomfortable. Now, he has a residential property in country T. I'm not solving it. I'm just trying to explain you that concept that we have just now discussed with all of you. He has a residential property in country Y from which he earned an income of $25,000 for the year ended 31st March 2022. He is eligible for a basic exemption limit of 8,000, and on the balance income he paid the tax at 20%. So how much portion, at least now foreign income, we will say, how much of the portion of the foreign income, students, residential property, students, in this case is how much, students? If you can see over here, is 25 minus 8. How much is that? 25 minus 8 is 17,000. 17,000. So 70,000 in the foreign country you have paid the tax. How much tax you would have paid in India, students, on this 25,000? Now please understand, in India, this is a house property income. Municipal tax, there is no municipal tax that they have given it to you. Straight away there would be a standard deduction, students. straight away there would be a standard deduction, students. And accordingly, students, that standard deduction will be 30%. So 30% of this comes to what? 30% of 25,000 comes to 7,500. 7,500. So in India, if you see, this is how much? 17,500. Can you see that, students? So what got included in India, obviously we have to convert it to INR, but just I'm telling you, what got included in India in the total income is 17,500. Whereas what got included in the foreign income, the tax was on 17,000. So when I calculate the doubly tax income, students, how much is the doubly tax income? That will be considered, students, the doubly taxed income on which there is this particular thing is $17,000. This is doubly tax income. Can you see the magic? What the IC has done it? This is known as the magic, students. Up till now, in all the questions, we were facing a situation where the liability that you have paid it in India was lower. The foreign, in respect of the foreign income, the liability that you have paid it in India was lower. Is it that what you have considered up till now? Yes. Suddenly, that in May 22, they have changed the table. See for yourself what they have done. The liability in this context is at $17,000. Whereas there, the liability is at $17,500. I hope that all of you have got hold with this one. So therefore, how much is the portion of the foreign income which is subject to double taxation? As you all are aware, the portion of the foreign income which is subject to double taxation is $17,000. And on that you will apply the eligible rate. On that, students, you will apply the eligible rate. Is that clear to all of you, students? Fine. And that exactly is the game. So with that, students, now let's move forward in our particular case study. Now I'll take you through to Mr. Patel question. Students, I'll take you through to now Mr. Patel's question. Okay. Let's start to deal with Mr. Patel's question. Now, Mr. Manav and all, everyone, this kind of a question, they are all similar. I'll just take you to Mr. Patel question quickly. Question 430. Question 430. So here is Mr. Patel, a resident of India and a senior citizen, give you the following information. So what information was being given to you? Just a second, students. So Mr. Patel, a senior resident of India and a senior citizen, gives you the following information. He owns a building in London. The same was on rent at UK Pound. Students, at UK Pound 12,500. Municipal tax paid was 10,000. So I have just added more sophistication in this question by giving you also about the municipal tax paid. And that was being paid in the current year itself. He paid interest on loan. So as you all know, when you do the computation, now please understand, didn't I told you when you do the computation normally as per the provision of the act, isn't it? So even if the foreign property is assessable, if it is assessable under the act, the computation has to be in the manner laid down under the act. The computation has to be in the manner laid down under the act, and that's exactly what we do. We do the computation in the manner which is laid down under the act. So here, students, in this context, we will be reducing the municipal tax paid and what not. The next one, he also paid the interest on loan that you have taken for construction. This is per annum. Be careful. Rest of the data were per month. Municipal tax was per annum. But here, interest is also per annum. Now, withholding tax at 20% on rent. So what is now this? Why this question is important? If you see, one more particular level is yet to be targeted. Up till now, even in this May 22 attempt, at least they have evolved to one level more. They have actually gone to the next level, but they have not touched the ultimate level, which is this question. Because in this current May 22 attempt also, they have got only a single tax rate for the entire income. In fact, there was only one income, house property income. So, but what is critical is that we have introduced more than one rate of tax. You'll say, sir, what is the difference when there is more than one rate of tax? So if you have got more than one rate of tax for more than one income from the foreign country, then for each income, you will have to do this particular step of comparing the foreign rate and the Indian rate for that income. Lower of the two will then be qualified for the purpose of application on the portion of the foreign income on which there was a double taxation. So that is how the things has to be looked upon, students. That is how the things has to be looked upon. So therefore, if you all see it over here in this context, what we are going to get it. So we will, in fact, the foreign rate on the rental part in UK was 20%. Fine. We will then keep that 20% in mind. Okay. Now this 20% was directly deducted on the rent. The rent itself, on that the 20% was charged. Whereas in India, students, you all are aware that the finally what will be charged to tax is not the rent but the net annual value, which will be determined after reducing municipal tax paid from the rent amount, after reducing 30% of standard deduction from the NAV, which will be reduced further with the interest amount, and then after that the net rental, which is the annual value, is going to form part of the total income on which the tax liability would be calculated. So therefore, in India, the portion of the rental income on which the tax would be charged would be lower as compared to the tax charged in the foreign country, isn't it? And that is the reason why the portion of the foreign income on which the double taxation has taken place will be reduced. The portion of the net foreign income on which double taxation has taken place would be the reduced figure. Coming to point number 2. He had a chain of departmental stores in India and a branch in London. He followed a cash basis of accounting. Following information was provided. Gross receipt is 1.75. So he has got the business income in India. In fact, in May 22 attempt, they have given you the business income in India. Okay, in May 22 attempt, they have given you the business income in India. This is what they have done it. But what we have also extended ourselves is there is also business in UK as well. So therefore, if there is a business income in UK as well, so gross receipt 30,000, expenditure 12,500. So that is the expenditure portion which would be reduced from the gross receipt. Further expenditure includes rupees 5 lakhs paid to Mr. Charles, a UK resident, for architect service rendered in relation to Indian stores, on which tax was deducted at 10% and paid. So students, in this context, obviously this is only for the Indian business in relation to the Indian store. So we don't have to worry about this. This is, any case, is in relation to the Indian store. So that particular expenditure, although what could have happened, we would have disallowed it. But here, since it was deducted and paid, so there is no such disallowances that needs to be done. Everything is proper, everything is fine. And thereafter, students, hear it. But please, students, be very careful. I'm just fearful on one more thing. Students, up till now, the ICAI has not targeted a hardcore calculation also. See, by giving this information, question number 2, I'm just trying to put across something in your mind right now so as to be making you mentally be prepared. Students, they can also try to enhance this kind of they can definitely, students, try to enhance this particular part of the portion of the question, wherein they can give you more particular items of, like, for example, they can give you that there is a cash expenditure that has taken place. So therefore you may have to disallow. So technically speaking, you may actually do the computation as well. And after doing a full-fledged computation, thereafter students, thereafter there is a tax liability calculated, and after that foreign tax credit has to be given. Up till now, whatever question that you are encountering right now, including the May 22 attempt question, they actually don't involve you in a hardcore headwise computation. They don't involve you on a hardcore headwise computation. At the most, what we have seen is that they may try to make you think on the application of chapter 6A. That is what they have done it up till now. But mentally be prepared, students, that they may also involve you to undertake a hardcore headwise computation, and that computation, after you have done with it, you will thereafter compute the GTI chapter 6A total income. So this is what primarily you may have to end up doing it, students. This is what you may have to then end up doing it. Is that clear to all of you, students? Fine. So this is what students, it has to be looked upon. So here in any case, no disallowances would be done. Tax on the business income in UK at 40% was paid on 30th of June 2022. What is the relevance of this? I will let you know a bit later. Come to point number 3. Mr. Patel has made investment in shares of companies in UK. Dividend received on 31st of March 2022 is 2,500. TDS at 10% on date when the dividend was paid. So this particular adjustment of point number 3, wherein Mr. Patel has made investment in shares of companies in UK and the dividend that is received is on 31st of March 2022 is how much, students? UK pound 2,500. Fine, students. The TDS, students, is at the rate of 10% on the date when the dividend was paid. The TDS, students, is at the rate of 10% on the date when the dividend was paid. Fine. You are required to calculate the tax liability of Mr. Patel in India after providing the FTC available. Students, now please have a look. There are different dates that they are given you the exchange rate, the way they have targeted in May 22. Although in May 22, you had only one income, which was that house property income. But here I have got 3 incomes. Any case, house property income, whatever is the amount that you will compute on the house property income, you will you will apply the exchange rate as on the last day of the previous year. You will apply the exchange rate as on the last day of the previous year, house property income. Business income also you will do the same thing, students. For the business income also you will do the same thing, which is the last day of the previous year. So this is for the HP and business income, the last day of the previous year. Where it will in fact change would be on the dividend income. Students, always be careful. Dividend income, interest income, dividend income, interest income, capital gains income, and salary income. These 4 income: dividend, interest, capital gains, and salary income. For these 4 income, the TT buying rate that you have to apply is, which is the TT buying rate that you have to apply? The TT buying rate that you will have to apply would be the month preceding the month in which these income, the last date of the month, the last date of the month preceding the month. Which month? The month in which these income became due or was accrued. So if got accrued or it became due in the month of March, so we have to take the preceding month last date, which is 20th of February. And that is what we will also do. If you see it over here, it is 31st of March, and accordingly my interest is on 20th of February. Again, I am repeating, this is in respect of the 4 income: dividend income, interest on securities, thereafter the capital gains, and the last one is the salary income. I hope that all of you are clear with this one. Now see the calculation, students, quickly over here. Just have a look the calculation part quickly, students. Just a second. Yes, students. So if you see it over here in this question, so in this context, Ajita, this 1,50,000, against that this $10,000 is what has been reduced, isn't it? And thereafter the NAV of 1,40,000 is further being reduced in this context. And after that, if you see the standard deduction at 10%, at 30%, the standard deduction at 30% is also being reduced in this regard. Then interest on the borrowed capital is 13,000 rupees. Interest on the borrowed capital is 13,000 rupees. Then IFHP 85. IFHP 85, and thereafter the last one, students, if you see, this is the TT buying rate. This is the TT buying rate, students, isn't it? So that is how the things has to be looked upon, students, over here. Now, students, in this context, students, one caution, students, over here, which I'll just tell you. Just now, students, you also made 22 attempt question. I don't try to convert it. Use this, be smart enough. Please drag it up till here. You just ensure, students, to drag it up till here, students. And therefore, what we are doing it over here is that, students, till 60. Can you see that, students? Calculate your HP income. Students, calculate your HP income in the foreign currency. And the net, finally, whatever is the net amount, students, that net amount is what, finally, students, you should be converting it into INR. That net amount is, finally, students, what you should be converting it into INR. Did you all got this one? So therefore, just be smart enough to do this one. Otherwise, unnecessary, what you people will do, each and every element you'll start converting. Don't do that. Even with today's paper also, students were saying the same thing. See, just imagine this, students. Even today's paper, students were saying it was lengthy. In fact, those who would have seen the last 3 to 4 attempt paper, they are the one who are rightfully, they could say that the paper is lengthy, not the today's paper, in fact. But yes, some students have struggled to complete the paper, I understand that. But the point is that why they may have delayed, first of all, a wrong selection of the question. I always keep on saying, don't do the MCQ at the start, because when you do the MCQ at the start, definitely your paper is going to be left. So ideally, you should try to select some of the descriptive question which you think you know the best. Use that, move on. 2 good descriptive question, that is a target. Then MCQ, because by the time you arrive at the MCQ, you have to be on the 4th gear, not on the 1st gear. Because 1 mark MCQ with the 4 options also flashing in front of your eyes of the solution, you should be in a position to be very fast to really solve it. If you don't get it in first stroke, there is no second chance. This is all the I am cat guys, people do it. And that is exactly what is their approach as well. So students, therein also is the approach. This is also should be your approach. Is that clear to all of you, students? Because otherwise, I cannot tell you, but herein I have seen students telling me that, sir, my friend has started with MCQ and thereafter he or she panicked thereafter. Because obviously you have spent 15 minutes with the known question. 15 minutes, students, you people have spent it with what? With the descriptive question, and you want to start with MCQ. And then MCQ would be very slow because you have not seen it, so very slow. So you are in the first gear in solving MCQ, 1 marks. So that's a 4 point. This attempt paper, ideally, students, it should not have been left. This attempt paper, it should be at minimum 90 marks attempt. Students should have done it. But that is what it is. We cannot say the same thing for November now. ICI does not. See, ICI, I should tell you that they will not be, बोलते ना, वो ज़्यादा मेहरबान हर attempt में नहीं होगा. So they will be very much will be very selective in showering their blessings on a particular paper. And if they shower their blessing, make it count. You have to make it count, students. And therefore the blame will squarely lie on us, not on the ICI in such kind of a scenario. So this is what students, we have to make ourselves well prepared, well in advance, and know our strategies well in advance. Not that decide on that 3 hours what we should be doing it and all those stuff. Gone. Anyway, students, so this, please understand, these are the silly steps, but they are the most important step in the examination day. Never try to convert from one particular stage which you people may think of doing it. Don't do that. So Ajita, that can be any particular paper, no? I'm just making prepared. It's just a DT. I gave you this particular thing. It could be any paper, isn't it? So the point is that if we have to be at our very best, point number 1. Point number 2, at least these kind of silly things we should not be doing it. My only submission to all of you is that, see, at final CA level, we should be at least be smart enough to know in this context. yeah. Don't worry, the ICI will show their grace, because obviously they also understand that they have got only few paper to really look into it. But nevertheless, the short point which I'm trying to address to all of you students over here is this, that here, if you see, don't get into that madness of converting each element with that conversion rate. Don't do that. 5 minutes will get spent in the process. I hope that all of you have understood this. Okay, and just be observant that, okay, this is what we should not be doing it. So what should not be done? At least take up the marking in this case. So 15 lakh students. So what 15 lakhs? It is the last particular day, 31st of March 2022. 31st of March 2022 is the conversion rate, and accordingly students have got the INR. Now if you talk about the PGBP, business receipt, I think that is sorted out. There is no much thrill. Indian income, any case, there was a threat of a disallowance for the Indian income. There was a threat of a disallowance for the Indian income. Students, that particular threat is now being relieved substantially. Students, you will also appreciate that particular threat has been relieved substantially, students. That is one thing which has been there. So therefore, in this context, students, that particular threat has been relieved, students, in this particular context. But please mentally be prepared. Again, I'm telling to all of you this point again and again, that mentally be ready with this particular thing, students. In the examination day, because the ICI is evolving, in the examination day, you can expect a full-fledged calculation. Just take an example. That example, if I have to give it to you, just consider that they will give you that an expenditure is disallowed. Say, for example, cash expenditure has happened, more than 20,000. Then what will happen? Then your expenditure amount, instead of 1.25, say they will say out of 1.25, 5 lakhs has been paid in cash. 5 lakhs has been paid in cash. So what I would have done? 5 lakhs has been paid in cash. Then what would have been done? Then I would have said that what would have been disallowed would be only 1.2. Sorry, what would be reduced would be 1.2 crores. What would be reduced, students, would be 1.2 crores. Isn't it? Yeah, that we will not reduce it. Here in that case, only because that out of 1.25, then 5 lakhs is something which is any case is disallowed, means it will not be allowed as deduction. So out of 1.25, then only 1.2 is left for the purpose of deduction. Only 1.2 is left for the purpose of deduction. That way it will keep on diluting. Okay, so just keep that particular presence of mind. So that is what I am telling to you. This is the area, students. This is the area which I feel is unexplored. Up till now, even in this May 22 attempt, they are not trying to manipulate on the headwise computation. Headwise computation is very straight. At the most, house property, like we have done standard deduction. That's it. Nothing more. This is their range up till now. What they in fact do is, sometimes in chapter 6A, like in Kalpesh question, 80 QQB we have seen. Here in May 22 also, they have done some 80 TTB, that interest expenditure. That kind of a adjustment that these people give it. So there is, at the most, they are trying to play in chapter 6A. But mentally be ready. Don't fear anything. If they give you a competition to be done, do the competition. And where the competition, students, they may target, they will not target the competition in house property. Up till now, the favorite head for them has been house property. Possibility now is there that they may get into PGBP also, wherein they can give you 2 or 3 adjustments to be done properly, and thereafter you will get your PGBP income, and on the PGBP income on that, thereafter you will get your GTI, total income tax liability. At the same time, students, please tell me here, just in the previous question, the way we have said that there is a set-off of loss to be done, we have done that. We have said that the set-off of loss has to be done. The brought forward loss needs to be set off. That is what we have discussed, isn't it? The brought forward business loss needs to be set off. Even though in the foreign country there is no set off. But in India, we do the computation in the manner laid down under the Act. So therefore, chances are very high that, say for example, they may involve PGBP income, and they will say that some of the disallowances, say the cash expenditure, let's say in the UK business, there is this 12,500. So instead of 12,500 pounds, they can say that 500 pounds on that, no TDS was deducted. No TDS was deducted on that 500 pounds. So what will happen? In that case, out of 12,500, then only 12,000 would be allowed as deduction. And then the net dollar would be reduced, $18,000 would be there. And on that $18,000, you'll convert the TT buying rate. Did you all got this one, students? Please tell me. Have you all got this one, students, clearly? And this is how this is to be done. And then apply the conversion rate and get this particular amount. After that, students, there is a dividend income that comes into picture. After that, there is a dividend income, student, that comes into picture. And you can see for yourself over here, $2,500 into rupees 62. $2,500 into rupees 62. TT buying rate as on the last day of the previous month, in which the dividend is declared, 1,55,000. 1,55,000. And the total income, students, 1,13,05,000. Okay, so that is the normal thing. This is the February month TT buying rate. Please understand, students, again, this is where, keep reminding yourself, this is where you will make mistake 2 times, which is that total income here is 1,13,05,000. 1,13,05,000, students. So it goes without saying there is a surcharge element that you have to be very careful about it. And here the surcharge would be at 15%. After applying the slab rate, then in that case, now here Mr. Patel is senior citizen, students. Senior citizen. He's a senior citizen, so therefore the slab rate has to be considered on a higher side, and that is how the things are there. Students, in this attempt question, like 115 BAC also could be there. Why that further expenditure of 5 lakhs? Remia, which particular point? No, here if you're talking about Remia, this particular point. Further expenditure includes 5 lakhs paid to Mr. Charles, a UK resident for architect service rendered in relation to Indian store, on which tax was deducted at 10%. So 1.25 crores include 5 lakhs. 1.25 crores include 5 lakhs. Now question was this, that if supposingly this 5 lakhs is not allowed as deduction, then what we would have done? We would have removed from 1.25 crores 5 lakhs. From 1.25 crores deduction of the expenditure, we would have reduced 5 lakhs. But is that removal required in this case? Is that removal required in this case? Answer is no. Why it is not required? You can see for yourself. Why it is not required, students? You can see for yourself. This is not required, students, because the TDS was deducted and it has been paid. TDS is deducted and it has been paid. So therefore, the question of reducing this 5 lakhs from this 1.25 was not required. But if there was a default, then definitely I would not have the entire 1.25 crores would not have been allowed as deduction. If there would have been a default, then from 1.25 crores, some portion would have been taken out. No deduction for that. But here full deduction is available, so therefore I have not taken out. Did you got this one? Why you people got confused? I also understood this. Because you are not, you don't have the habit of computing business income from sales minus expenditure. Up till now, all of us are having the habit of from net profit we are doing it. And from net profit we are doing disallowance, add and less. And therefore this is a reverse way of thinking, that if you have got a gross receipt, and you have got a expenditure and the attack is on the expenditure, then the expenditure amount for deduction purpose may get reduced. The expenditure amount for deduction purpose will get reduced if there is a disqualification. I hope that every one of you will have got this particular point, students, now. Yes. So this is precisely the point, students. Now then. So students, this is what it is. Now I think, okay students, again I'm repeating, tomorrow's time would be 10:30. Yeah? I'm just repeating to all of you, this tomorrow's timing would be 10:30. Now you will say, sir, for how many hours the lectures are there? The lectures are there for students around 2.5 hours. Okay, so every day 2.5 hours lectures. Every day means at least I can tell you 2.5 hours, 2.5 hours, 2.5 hours. The 3 days, the lectures that we have is for 2.5 hours. Fine. So that is the point wherein we have got lecture. The 3 days that at least we have got Saturday, Sunday night and Monday. Fine, students. Yeah, effectively it will become that way only. Effectively, students, yes, you are right. But at least because that's the only time which I have got it to solve it. Otherwise, I don't have time because the lectures schedules are very tight. So that's the only time I can really devote it for this session. But let's do it and it's worth it. Now, students, coming to the last particular calculation, students, Indian rate, students, Indian rate. Okay, everything is there. The link, students, I'll keep on sharing with all of you in my Telegram channel, CA Durgesh Singh. So there itself you'll get it, or also subscribe to this particular channel so that you get the notification. Now, students, over here, average rate. First of all, Indian rate. How to calculate the Indian rate, students? If you have to calculate the Indian rate, you all are aware that, students, this is what you need to do. The tax liability with the total income. The tax liability with the total income, students. This is how you will calculate the average rate of tax. The average rate of tax, students. Isn't it? This is how you will calculate the average rate of tax. So that's precisely how you will get the average rate of, and thereafter the foreign tax credit. Thereafter, students, the foreign tax credit, rule number 128. Now see, in this context, students, how do you go about it? Here, every particular income, students, be careful, every particular source. Amruta question, Kalpesh question. Did we did for each source? Amruta question, Kalpesh question. Did we did for each source? Please tell me this. Answer was no. Why is it so? Why we didn't did for each source? What was the reason behind that? Reason, students, now you all know. The reason was this, that there was a singular rate for all the income. Like check for Amruta. Students, check for Amruta or Kalpesh. The foreigner, what is the reason? Please try to identify the reasons for all these things. In the examination, even May 22 attempt, there was only singular rate. Because of singular rate, see here, Amruta question. The Kalpesh question, 20%. So, what we do in the foreign tax credit, students, compare the foreign rate with the Indian rate, and the lower of the two is what is applied on the portion of the foreign income which is subject to double taxation in both the country. Isn't it? That is what we do. Here also, if you see, for Amruta, 15% was the rate which you have calculated. So because there was only single rate, May 22 attempt was also single rate. See, you should know what could be the varieties of the question. And on that basis you have to finally conclude. So here finally, students, finally you will have this particular point wherein we are doing for each source. We have to compare. Now, first is rental income. UK rate was 20%. Indian rate is 33.87. Lower of the two is 20%. This 20% would be applied on what? This 20%, students, would be applied on that portion of foreign income. Which is subject to double taxation. That portion of foreign income which is subject to double taxation, students. isn't it? So therefore, that is how the things has to be looked upon. So is it that 85,000 the answer? And the answer is yes, students. You can see for yourself, 85,000 is the answer, which you can see for yourself over here. I hope that all of you have got hold with this one. 85,000 we just now calculated. Na? In India, there is a standard deduction and also the deduction of interest. And after all these deductions, finally our net answer is how much? Finally, students, our net answer, I have already have told you what is our net answer. So, students, all of you are clear with this one? Now, last point, students, last point. All of you just pay attention. This dollar applied. Now, this is what? In this context. In this context, students. See here, students. So lower is $85,000 into 20% being the low rate. Now this 85,000 is that portion of the foreign income which is subject to double taxation. Means therefore 85,000 and low rate is 25. So therefore now what is $85,000 into 20%? What is this 85,000? 85,000 into 20%, students. What is that? Students, this is a foreign tax credit. Foreign tax credit in dollars. Now I need to convert it into INR. So the conversion rate would be, what is the conversion rate? The last date of the month preceding the month in which the tax was paid. What is the conversion rate, students? The conversion rate herein, students, is the last date of the month preceding the month in which the tax was paid. Tell me in which month the tax was paid? Which month the tax was paid, students? As far as this is concerned, for which month the tax was being paid, students? So the tax was being paid, students, in which month? Quickly. In the month, for the first one, students, for the first one, in the month of March, for the month of March. So therefore you will take 20th of February. You will take 20th of February, students. 20th of February, 62. I hope that all of you got hold with this one. What about business income? For which month you have paid the tax? 30th of June. So if it is 30th of June, so in that case, the preceding month last date would be 31st of May. Preceding month last date would be 31st of May. Isn't it? And what about dividend? When you have paid the tax? 31st of March. So 31st of March means I'll take 62. So that is precisely how you will do. So if you see over here, students, if you see it over here, you get it 62. You get over here 62. And then here business income 65. 65 was the month of April. Is that clear to all of you, students? Now, students, can you do this question? Last question for your practice purpose, students. See this question. Question number 431. Straight away, students, you will go through this, and in any case, if you have got any query, please ask me straight away, because this would be your last chance. After that, there is no other chance, and then I will quickly run through other questions from this one. We are done with this chapter then. Quickly, students, read this question 431 now. It's fine now. Scroll up. Students, one couple of case laws are not asked. I'll do it tonight itself. Very important, which I think for your main normal return. Okay? First we'll complete this and then I'll do that. This was not asked in today's paper. Uh, normal. through this one, students. And students, one more request, that since we will be calculating, it's a practice of the problems, please do ensure to sit with the calculators, because it's all practice questions that we are solving, and I'll involve you also in the calculation part. Okay, so just keep that in mind. So friends, if you all see over here, so your Indian income 5 lakhs, foreign income which has been given to you, in which house property income primary which has been there, PGBP income which was also being given to you, IFOS income. I think the conversion rate also, I think you all are aware of it. Now here in this context, students, there are two countries which have been given to you. Two countries have been given to you, isn't it? And since you have got two countries in this context, students, since you have got two countries in this context, be careful. 31st March, this is where the silly mistakes are going to be very high. See, we have to also identify where you people will go wrong. So therefore, please understand that you will do a big blunder, because one country here it is 62, which the business income from, it is from USA, and house property is this 85. Do you know what you people will do? Chances are very high in a silly mistake area, you will do 62 for UK and 85 for the business income. This is how these questions are being set. So therefore, just be very, very careful on this part, because these are the areas in which you people do silly mistakes. Anyway, should there are two countries, ICA again will be manipulative to give you the standard rate for both the country. Say they will give you 10% rate for both the country. Okay, so if the rates are standard for both the country, does you mean that you will consolidate all the income and thereafter you will give the credit? Is that the way you are going to give the credit? No, the credit has to be given country wise. So always be very careful here. The credit has to be given for country wise. And accordingly in this context, so in UK which was there, and in USA separately, in this situation, UK separately, USA separately. So therefore you have to be careful. And the beauty of it, students, did you know the tax rate is the same? The tax rate is the same. 10% is what is the tax rate. That's the beauty of this entire question. So if the temptation would be very high for on your part to club everything at one, club everything as one, students, and thereafter, because the tax rate is the same, na? Just the way we discussed for Amruta, just the way we discussed for Kalpesh, because the tax rate was the same, therefore that influenced our calculations. Are we going to do the same thing over here? Answer is no. Don't do this blunder, students. Each country you have to show the credit calculation separately, even if the tax rate is the same. So the chances could be very high. Here the question does not give you that particular leeway. But please be careful. Supposedly there is a brought forward loss for UK. Then what would have happened? If there is a brought forward loss for UK, then that brought forward loss from UK would have been set off only in respect of the UK's income. While calculating the UK income, only that brought forward loss would have been set off. Did you all got this one? And you would not have influenced this with the USA. USA would be considered separately. So therefore, that is the point, students. That's a limited point which I thought to just bring to your notice. And as you all are aware that this 10% is this one and this was a straight thing, and accordingly, this is how the tax liability would be considered. I hope that all of you are clear with this one. Now friends, FTC and the MAT credit, primarily we have to do first the MAT, and in the MAT there is one question. In MAT I'll let you know. Same question is there in the MAT, and accordingly in the MAT I'll let you know how do we go about it. Now friends, this was again one practice question. This is a simple question, so you can students now take this question as a homework. Question 433 as a homework. It's a simple question. Now we have done with all the complications. Please do ensure to practice whatever I am telling you in the compiler box. so that it takes 2 to tango, isn't it? It will take 2 to tango. Now question 434 I have discussed in lecture number 1. So that lecture number 1 we have already made a discussion, and that is what it is. Now let me come to question 435. Mr. Roy is a resident of both India and USA. In the previous year 21-22, he owns immovable property including the residential house in both the countries. He earned income of rupees 50 lakhs from rubber estates in USA during the financial year 21-22. He also sold some house property situated in foreign country, resulting in short-term capital gain of rupees 10 lakhs during the year. Students, be careful on this particular part. So Mr. Roy is a resident of both the countries, of both India and USA in the previous year 21-22, and he owns immovable properties including the residential house in both the countries. And after that, what they have mentioned, he earned income of rupees 50 lakhs from rubber estate in USA. Now one thing, whenever this type of question, students, please expect this type of question in November 22. It has been long that they have not asked this question. But earlier, I think between May 17 and November 18, 2 or 3 times they have targeted this question. Between May 17 and November 18, 2 or 3 times they have targeted this. Students, whenever you become a resident of both the countries, in fact, this type of question for those attempts, it was way ahead of the time. It was way ahead of the time. But now with the new course and with the chapter of the model convention, this is perfectly ripe for the current moment. This is perfectly ripe for the current moment, students, and that's the reason why I'm telling you, you just be very careful on this particular part. So what they are suggesting over here, students, is that Mr. Roy is a resident of both India and USA in the previous year 21-22, and he owns the immovable properties including the residential house in both the countries. And after that, he earned income of rupees 50 lakhs from rubber estates in USA during the financial year 21-22. Now, if you know from the tie break rule, are you aware of the tie break rule? How do we? So if you are a resident, see one thing, just pay attention, students, to this concept. Whether you are a resident or not, that will depend upon your domestic law. The domestic law of each country provides a distinct test as to how a person would be considered as a resident or a non-resident as per their laws, their taxation laws. So Indian taxation law, so far as the individual is concerned, requires the physical stay in India, on the basis of which they decide whether the individual could be considered as a resident of India or not. Similarly, if you talk about USA, the thrust or the emphasis that is placed is on whether you are a citizen of that country or not. So on the basis of the citizenship criteria, they decide the residential status of that particular individual. So therefore, chances are very high that Mr. Roy, probably whom being a citizen of USA, may have stayed in India for more than 182 days or above, and thereby he has become a resident in both the countries. And if he has become a resident in both the countries, let's proceed further. So Mr. Roy is a resident in both India and USA in the previous year 21-22. He owns immovable properties including the residential house in both the countries. He earned income of rupees 50 lakhs from rubber estates in USA during the financial year 21-22. He also sold some house property situated in foreign country, resulting in short-term capital gain of rupees 10 lakhs during the year. So he also sold some house property situated in foreign country, which resulted into a short-term capital gains of rupees 10 lakhs during the year. Okay, now Mr. Roy has no permanent establishment of business in India. However, he derived rental income of rupees 6 lakhs from a property let out, and he has a house in Lucknow where he stays during his visits in India. Perfect. Now students, this Article 4 in the old course, they used to give this Article 4 to all of you. But in the new course, I will tell you, they will expect you to know what is Article number 4. Article 4, because the Model Convention Treaty which is giving to you, this is part of your chapter syllabus. So ICI now will expect you that you should know what is Article 4, and whenever a person is a resident of both the country and therefore there is a tie break, how do you resolve this tie break? Because then in that case, the world income is taxable in both the countries as per their domestic laws, because they are resident of both the country. So that cannot be the position. If you have to apply a taxation law, you need to define one country to be a country of resident and another country to be the country of source. Only then you can proceed with this concept of double taxations and all. Otherwise, you will get stuck badly. And that is the reason why it is a treaty which resolves this sort of a dispute. And what the treaty tells you? The treaty, students, tells you in this particular case that how do we resolve this particular dispute. And the way to resolve this particular dispute is, students, is follow the steps sequentially. Students, you need to follow the steps sequentially. And the sequential step is this, that check where he has got permanent home. Between the two countries, where he has a permanent home. Now, chances are equally very high that he may have got permanent home in both the countries. So, if that does not work, then go to the next step. And the next step is to identify where is his center of vital interest. Where is his center of vital interest? When I say center of vital interest, it means both economic as well as personal. Whenever we say the center of vital interest, it means both economic as well as personal. So in that particular case, you will have to see economic as well as personal means the financial, where he can be said to be independent, and personal means where his family resides, kind of a thing. So that way you will have to then resolve through this particular second test. But chances are equally very high that this is also divided between the two countries. Because say for example, he is earning in both the countries. Say for example, his wife and children is in one country, parent is in other country, and he keeps on jumping from one location to another location at every given point of time, so as to be there at both the places. So therefore, in this situation also, you may not get the result in step number 2. Then if step number 2 does not work, go to step number 3. And what step number 3 says? Step number 3 says, then find out what, students? Where he is habitually residing. Habitually, where does he reside? And again, the problem, so accordingly, habitually, where he resides, that is the third step. Now, again, there could be a problem. He is habitually residing in both the countries. And if that, generally this can happen between a country like Singapore and India, because the location, the distance is not that far. And therefore, he being reside, or Dubai, India. So therefore, again, the distance not being very far off. So that is where the problem will rise. And therefore, then you go to the next step. If habitually you are residing in both the countries, and therefore this particular step cannot be worked out over here, then you follow the next step. And in the next step, students, then what you get it, students? In the next step, students, what is that you all get it? You should be aware of this one, students. In the next step, students, you all know that thereafter, nationality. Are you aware of that? Nationality is what has to be seen. And if suppose there is some case of dual nationality, you people may be aware. In many countries, you all are aware that there is a concept of dual nationality. So if the dual nationality is what is being followed, then you go to the last step, students. And are you aware of the last step, students, in this case? So the last step, students, in this particular case is that now you should not try your luck. Do one thing, directly apply to the respective, go for the map. Go for the map. So this map has not been targeted in theory. Chances are very high. November 22, they can target this map in the theory part. So what is map, students? Map is a mutual agreed procedure. So mutual agreed procedure. What does this mean? That you, because you are resident of both the countries and you are not in a position to get your answer as per the sequential step of article number 4, then you will then make an application to the CBDT of India, the highest authority, and as well as the highest tax authority of US. In this example, it is US. Make an application and tell them that look, as per Article 4, I am not in a position to resolve as to which country between the two should be considered as a country of resident, so that the other country could be considered as country of source. I am not in a position to decide. So you both come together and decide for me which of the two country I should be considering as COR, so that other country becomes COS. And therefore, at the time of assessment, there should not be any dispute. And that is precisely what is the concept of map. But this is a last recourse, okay? So here, students, if you see, let's have a look. What did I told you the first step? The first step is the permanent home. Now, does he have a permanent home in both the country? Answer is yes. He owns immovable property, including residential house, in both the country. So first step does not give you the answer. What about the second step? The central of vital interest, both economic as well as personal. So 50 lakh he earns in USA. Okay. Also 10 lakhs he has earned through a short-term capital gain, so around 60 lakhs. Whereas in India, he is earning 6 lakhs. Okay, so therefore in this case, this is what it would be. So it implies that his center of vital interest, both economic as well as personal, is very, very high in USA. And therefore, can we say safely over here that his COR is in USA? Can we say safely over here, students, that his COR is in USA? And the answer is yes. So USA over here is COR and India will become COS. India, students, is a country of source. Country of source. I hope that all of you agree to this particular point. If this is what all of you will also agree upon, now therefore, you have to do what in this context? You are required to state with reasons whether the business income of Mr. Roy arising from USA and capital can be taxed in India. So India is a country of source. So you tell me, students, in this case, if he is a resident of USA and India is a source country, so tell me whether the business income of Mr. Roy arising in USA, if he is a resident of USA, students, and India is a country of source, okay, India is a COS, so income which he has earned in USA, can it be taxed in India? For India, therefore, students, for India, he is a resident or a non-resident? For India, he is a resident or a non-resident? For India, he is a non-resident. So if he is a non-resident in India, then the business income that he has got in USA, can it be taxed in India? Answer is no. It cannot be taxed in India because he is a non-resident, isn't it? And what about the capital gains? Again, the same thing. Capital gain is also earned outside India. So when it is earned outside India and when you are a resident in, when it is earned outside India and you are a non-resident in India, then how is it that you can tax it? You cannot tax it, isn't it? And that exactly is the point. So I hope that all of you is there. So just I'm putting you to the conclusion. But be careful, students. Just read these 2 points. Are you taking the treaty benefit? Students, are you taking the treaty benefit not to pay the tax in India? Tell me, are you taking the treaty benefit not to pay the tax in India? Yes, you are invoking India USA DTAA. So as to finally conclude, because otherwise, if you would not have invoked India USA DTAA, then in that particular case, as per the Indian Income Tax Act, you are a resident in India. If you would not have invoked India USA DTAA, then as per the Indian Income Tax Act, you were the resident itself. Do you all agree to this one? As per the India USA DTAA, sorry, if you would not have invoked India USA DTAA, then as per the Indian Income Tax Act itself, you are a resident. It means that this income, world income, would have been taxable. But now you applied India USA DTAA and you have invoked Article number 4, took the treaty benefit and became a resident of USA and eventually became a non-resident for India in a way that now you will not be liable to pay tax on the income that you have earned in USA. And therefore, will you now be required to furnish the TRC to the Indian tax authorities so as to ensure that no tax is being charged in respect of the income that he has earned in USA? Answer is yes. And that is exactly what this point is. So students, all of you just very quickly go through the last two paragraphs and we take thereafter the next question. Students, this question is very important. 436 mark, very important on the day of the examination. Do ensure to go through the same ones. 436. Quickly run through this question. Now, friends, if you see, rest everything is fine so far as the question is concerned, and you would have noticed one thing, that it became similar to what you people have done it just some time back, isn't it? It was more or less appearing to be similar to what you people have done some time back. But the catch of this entire question is this, students. The catch of this entire question is this one, students. Students, over here, if you see very carefully, see, one thing is there. Just again, they have given you article number 4. See, they are giving you article number 4, but don't expect in the examination that they may give you article number 4. Same thing again and again, they are mentioning it. Now, he has permanent home in both the India and Australia. So, obviously, this cannot be the deciding factor. Now, he earned in Australia 6 lakhs as other income. His family stayed in India. Okay. He also derived rental income from a property let out in India. Now, students, if you see very carefully, his center of vital interest, when we talk about vital interest, students, would mean both economic as well as personal. Vital interest, students, would mean both economic as well as personal. So that is what this center of vital interest is all about. Economic, personal and economic relationship. His family is in India. He is also earning the income in India. Yes, India is both. Okay, so therefore his family is in India. Also he is earning the income in India as well. So therefore the center of vital interest happens to be in India. India therefore will be the country of residence. And accordingly the other one, Australia, would be the country of source. So in India, world income would be taxable, but be careful. Now India, he is a resident of India. He is a resident of India. Now this is where the real game starts. This as per India Australia DTAA, the income would be taxable in country where it is earned and not in the other country, but would be included in the computation of tax rate in such other country. So the income, students, would be what the treaty says, as per treaty, that tax only where it is earned, and they are specifically debarring the other country from tax. See students, one thing which is there, be very careful the language. Now you should be smart enough in your examination, these languages are critical. If they would have given you here the income just like this, majority of the time the language is like this: the income may be taxed in the country where it is earned. In the country where it is earned. Okay, which means Australia in our example. Which means Australia in this example. Isn't it? But if this is a phrase which has been given to you, my next question to all of you therefore is, can India also tax this particular income? If this is the phrase that has been given to you, then my next question therefore is, can India also tax this income or not? If this is the phrase of the treaty, because 90% of the treaty you will find this phrase only. If this is the phrase which has been given, that the income may be taxed in the country where it is earned, so if this is only what has been written, can therefore India also tax this income? Answer is yes, it can. So this does not debar India from taxation purpose. So what India can do is that India can include that particular foreign income in this. If this would have been the phrase, then India could have included this particular foreign income as a part of its total income, calculated the tax liability, and thereafter from the tax liability it would have given the relief. The way we already know how the relief has been given, just the way the previous question that we have solved so far. But see the language of the treaty of this question. See the language of the treaty of this question. What they have mentioned over here is that as per India Australia DTAA, the income would be taxable in the country where it is earned and not in the other country, but would be included in computation of tax rate in such other country. So income would be taxable in country where it is earned and not in the other country, but would be taxable in the other country, but would be included in the computation of tax rate in such other country. Is that the point clear to all of you students? Every one of you. So here what we will understand. Now you tell me over here, if this is the language, whether while you compute the total income, will this foreign income that you have earned in Australia, will it form part of your total income? In this kind of a scenario, the phrase which has been given to you, whether this particular foreign income, will it form part of your total income? Answer is no. It will not form part of the total income, isn't it? Because they are clearly telling you that it shall not be taxable in the other country, meaning thereby the country of resident, they are putting a reservation. But they are relaxing to consider this foreign income in the country of resident only for rate purpose. So if it is to be considered only for rate purpose, means only in the working note. You calculate that, you consider this foreign income and then decide what will be the effective rate of tax. And then decide what will be the effective rate of tax is what students you need to take into account. Is that clear to all of you students? All of you are clear with this one? So therefore students, this is how the things has to be considered. And accordingly now, what is the solution? Please have a look in this context. See the solution. See the solution. See here, if you see in the total income, Ajita, Ramaya, in the total income, you will not find that foreign income at all. Missing completely. So my total income is completed over here. If you see carefully, my total income is over here itself, 2,02,500. This place, at this place my total income is over. And in the total income, 80D is there. Students, we have missed that adjustment, but just let it be for a time being. So in this case, you have Indian income, rental income, then standard deduction 30%. Then you have got the GTI, and thereafter chapter 6A, and then you have got total income. No foreign income. But now I am adding this foreign income separately. Why am I adding foreign income separately? Just to calculate the rate. And therefore, in this context, after I calculating the foreign income, my rate, effective rate, is 9.46. So this 9.46 will be the final rate of tax which would be applied on this purpose. 9.46% is the rate that would be applied for this particular 2,02,500. Can you see this one? 2,02,500. On this 2,02,500, you are applying this 9.46%, and that is what gives you 19,157. 19,157, and that is what you finally will do the rounding of. Is that clear to all of you? You will then do the rounding off. I hope that every one of you are clear with this one. Fine. Now, if he does not have DTAA, then obviously that paragraph of article of the treaty is not applicable. That paragraph of article of treaty is not applicable, and which will then mean that I will include in the total income. I will then include automatically, this will get included. Both foreign income and everything will be included. You will calculate the tax finally and then average. This is something I think all of you are aware. Now, students, in this context, this question also, now see, I am just wondering, students, I am just literally in the state of wonderland right now. In the old course, when these things were not there, ICI, I told you they were ahead of their time in the old course. And now in the new course, all these things are expected from all of you to know. What was there in the old course? In the old course, they used to tease the students. How they used to tease the students? They used to give you a paragraph of the treaty. Now there is no teasing that they will do. They will expect that you should know the paragraph of the treaty, because you have the chapter. Which chapter? Overview of the model convention. So how beautifully they will set you up, students. They will expect you that you should know the application of that particular treaty, how you do the application part. And one of the part is that of the non-discrimination article. Students, this non-discrimination article is also a very tricky article. Not tricky, it's a simple article, but it's a very important one. In all the treaty, students, you will find one standard non-discriminatory article. Standard. And what is that, students? They will say that, that the non-resident should not be distinguished with the resident in the domestic law unfavorably. The non-resident should not be distinguished with the resident in their domestic law unfavorably, which means there should not be any discrimination between non-resident and the resident in the domestic laws. Now, one of the very obvious discrimination that you can see, one of the very, very obvious discrimination, students, that you can see is on the tax rate front. Because whereas in the case of the domestic company it is 30%, the foreign company is at 40%. But the government of India very intelligently, by introducing an explanation to section 90, what they have done, they have categorically, they have said that it is hereby clarified that, the fact that the foreign company is taxed at a rate which is higher than, the rate of a domestic company, that by itself will not be considered as a discrimination. So through a specific provision, we have made it very clear that the fact that we have a higher rate of tax of a foreign company vis-a-vis a domestic company which is a 30%, this by itself will not be considered as a case for a discrimination. And why we would have done that, students? We would have done that because we find that across the world this is the same practice. So we also have adopted the standard practice which is followed across the world, that in respect of your company which it has been incorporated in your country, there is a lower rate as compared to the foreign company's rate. So this happens to be the standard practice, but you should not have any position or a scope to put a finger on us or point a finger on us to say that India is doing a discrimination between a non-resident and the resident in their domestic law. Not explanation 5, I think it is explanation 2. Explanation 5, Ajita, it is that 911 indirect transfer. It is actually explanation number 1. Explanation number 1. Okay, so this is what it is, students. Now, students, you just read this 438. This is a theory asked in November 18 syllabus. Just read this one, and if you couldn't understand the part of it, please do let me know. This was a theory asked in November 18 new course. Please go through this once. So typical theory, I have kept it over here. Just read it once and just understand if you've understood, and if some part you have not understood, do let me know. I'll make you understand this. I've done this one, friends. We're talking about this diagraph. Students, first of all, this is a CBD circular. However, I must say that again, this is a part and parcel of your that model convention. So beautifully they are using. See, this is why I feel that this attempt, the paper was, I think, relatively simple, and you have to always, I always feel that particular chapter of model convention. This model convention chapter can be mixed up with this particular chapter very easily. And this is what they have done it. That last paragraph, Ajita, that you are talking about it, which you are talking about it in this case, is actually one of the paragraph of that model convention of article number 7 on business profit computation, which is actually the permanent establishment. Students, let me first explain you this, and thereafter I will just tell you to do this one. So what happens, students, is that as per the treaty, a business profit, as per what? As per the treaty, students. See, when there is a business income, so a non-resident in India, supposedly it has got a business income. Okay. So as far as the Indian income tax law is concerned, a business income is taxable if you have got a business connection in India. That is how a business income becomes taxable as per the domestic law. But then obviously, because the income becomes taxable as per the Indian income tax law in India, at the same time, you being a resident of USA, the same income would also be taxed in USA as well. All of you will agree to this one. The same income will also be taxable in USA as well. So this will give rise to a double taxation. Isn't it? And therefore you will have to apply the treaty. Now, what the treaty says for a business income, students. So that chapter of model convention also will have a good role to play over here. The treaty says, students, that if supposedly you have got a permanent establishment in the country of source, means where you have earned the business income, if you have got a permanent establishment, then whatever is the profit which is attributable to the permanent establishment which is situated in the country of source, that much of the portion of the profit will be taxable in the country of source. That is the country where you have earned that particular business income. Okay, now first and the foremost thing, students, you should understand what is the concept of permanent establishment. Now, permanent establishment has been defined in the treaty, for which you need to refer article number 5, your model convention chapter. If you see, students, also one more thing which I'll request to you, also keep the booklet with you, whichever book that you are referring. Like for example, Ajita, you are referring to charts. So you just keep the chart also handy, so that parallelly you people can also go back and refer that particular provision, whatever I am trying to explain at that point of time. Okay. So quickly, it should be like see, one thing which is there, one thing, students, be very clear on this. Your revision, which is very important. See, understand what is the problem of all of us. The way we revise is like this, that we will revise everything. And that revision is theoretical. And then we also refer practicals. That is what it is. But the real revision is referring to when we are doing the practical, at that time immediately referring, cross-checking the theory as well. This is what is a real and the most formidable last revision. The last 4-5 months when you are doing it, because you know the provision. Now a portion of the provision you need to refer for the application part, and this is where you need to keep on flip-flopping. Otherwise, what will happen, our revision goes like this. Again, we'll open that chapter. Again, we'll go from first page, second page. You'll read full, and we'll end up the chapter. We'll be happy and we'll move on. But we will get stuck whenever there is an issue which is there in front of us, and when we have to refer some part from that chapter so as to fully understand what exactly that particular point was all about. And that is the reason why, students, your revision while you do DT has to be as particular swift as possible, and that is the reason why you should revise in parts. Ajita, the model tax convention which I was talking about it, I will ensure to keep all the new course theory topic. It is there in that particular. I've already done the theory topic. Unfortunately, I cannot share the link, but if you can text me, message me after the lecture gets over, immediately will be giving it to you. It is there in the chart also. So I'll just share with you that Model Tax Convention YouTube link, those who want it, but it is also would be shared in this link, this particular video link. So those who would be watching later on, you can just check the this description box. You'll find a theory topic on non-resident taxation, which is exclusively for the new course only. So in that Model Tax Convention is covered. Okay. So because obviously in the compiler session we don't have that topic because it's a theory topic, isn't it? So that's the reason why. Please do ensure to go through the topic, and I will be in a position to explain you in this particular way. So friends, coming to this particular concept. So now I told you, as per the treaty, friends, what is the position? Position is that the business income will be taxable in the country where the permanent establishment is situated. And then how much of the profit would be taxable? How much of the business profit would be taxable in the country of source? That much of the business profit which is attributable to, the permanent establishment in India, that much portion of the profit will be taxable. I hope that all of you are clear with this one. Now the question is then, what is permanent establishment? The question is therefore, what is the permanent establishment? Article 5 of the DTAA defines the permanent establishment. And how is the definition of permanent establishment? Simple definition, students. It says that permanent establishment means a fixed place of business through which the non-resident carries out its business and profession. A fixed place of business through which the non-resident carries out its business and profession. So that is the permanent establishment. Did you all got this one? So this is how they have defined, sought to define the permanent establishment. I hope that all of you are clear with this one. This is how that they have sought to define the permanent establishment. Fine, friends. So this is what it is. So now if you see in this question, the non-resident has got a BPO in India, IT enabled service BPO in India, isn't it? And it provides certain outsourcing services to residents. So through the BPO in India, it is providing, like many, you all know, foreign company has got a lot of BPOs in India, and through that BPO in India, they are trying to service the Indian clients. So can we therefore say that BPO in India of that foreign company act as a fixed place of business in India through which the non-resident is performing its services? Yes, it definitely can be considered to be a fixed place of business in India through which the non-resident is performing the services. And accordingly, students, in this particular context, whatever is the profit of the non-resident which is attributable to this particular, BPO in India, that much of the profit will be taxable in India. Do you all agree to this one? That much of the profit which is taxable in India. Now, when you talk about profit attribution, so you have to calculate the profit. When you have to say that much of the profit which is attributable to the BPO in India, that much of the profit of that non-resident will be taxable in India. So when you talk about profit attributable to the PE, it implies that you need to compute the profit. And then how do you compute the profit? See here. In determining the profit of the permanent establishment, there shall be allowed as deduction expenses which are incurred for the purpose of permanent establishment, including executive and general administrative expenses so incurred whether in the state in which the permanent establishment is situated or elsewhere, like the head office expenditure. The portion of the HO expenditure would get attributable to the Indian PE also. And therefore, in computing how much is the profit which is attributable to the Indian PE, whatever is the expenditure of the PE, that you will reduce. Obviously, you will reduce that expenditure. Also, the general administrative expenditure, like the head office expenditure, will be attributable to the PE in India for the purpose of deduction to compute the profit attributable to such PE? Answer is yes. That also would be taken into account. I hope that every one of you are clear. 439 students, all of this question 439 you will take it as homework. Did you all got this one, students? Fine. Any doubt that you have, we are done with this topic. Any doubt, students, you have it, please ask me. Otherwise, now we are done with this topic. So tomorrow, students, we will be doing the equalization levy. And obviously, as I told you, we will be in a position to start with transfer pricing. So equalization levy and transfer pricing is what we will be in a position to start in tomorrow's session. Okay. So that would be the case. So I think tomorrow, next 3 to 4 session, I think transfer pricing would be over. So you can say by 30th or 31st of this month, we will be done with transfer pricing also. So full non-resident taxation as well as transfer pricing is over, would get over. And as I told you, theory topic, I'm going to give you the link, sharing the link in this description box and all. And finally, thereafter, students, we can kick off with our next step of PGBP, as I have told you at the very advance itself. Okay. Any doubt, students, you have any query, concerns that you have to ask? Please do ask me. Now, students, one thing is very clear. Invest yourself into it. Your next 1 month is very critical. I must tell you straight away in this case. Next 1 month would be very critical for all of you. Because see what happens after the examination is over, generally that next 1 month period is a lull period. The problem is that the May attempt students, they are having the cooling period. But even the November attempt students want to give them the company. To whom? To the May attempt students. And by giving the company to the May attempt students, they also get into the cooling period. Please don't do this blunder. This 1 month is very critical for all of you. You don't have to go into this cooling period along with what the May attempt students will do. Because what happens in the month of July, the results are out. That July attempt is always a pressure attempt. That month. The 1 month is the most critical month, students. So you just show your self-determination, your own willpower, a self-motivation, and just stay consistent to ensure that the things are being taken care of. Like for example, I will not be taking daily 10:30. Till 31st I am doing daily 10:30 because I have to complete till transfer pricing. Once I am done with this, then the next particular from June, every week it will be 6 hours. From June, students, every week it will be 6 hours. That is what. I may take only 2 days or I will take 3 days depending on every week. So that will be 6 hours every week. I'm just telling you the entire schedule also. So June would be 6 hours a week. So in the entire June will be 24 hours. Okay. July also would be 6 hours a week. So accordingly 24 hours. And we'll be done with July everything. Entire DT would be over in terms of the compiler and all. All the practicals, everything would be over in July. So therefore, this is what I have done it. So my only point is that. Unfortunately, Ajita, that's my only challenge. Just manage the 31st. You just manage up till 31st. Okay. And thereafter, maybe manage only the weekends. Because as I told you, in the month from June onwards, it will be only up till, what did I told to all of you students? Just manage up till 31st here in this month. So that at least our transfer pricing is over. And you people will also feel that, okay, we have done substantial thing now. 30 marks we have covered up. Isn't it? And if possible, by this Sunday, I am giving you this theory topic link. Sunday, I am also giving you the theory topic link, isn't it? So finish it off so that at least back of the mind, you people are aware that my 30 marks is over. So you just imagine the kind of a confidence that you will always have. See, you should try to ensure to bounce back and you should always have the upper hand. You should not let the time dominate you. You should be in a position to dominate that particular present scenario. So therefore, that extra effort is required so that by 31st, why it plays psychologically that my NR and transfer pricing is over. Okay, and therefore that theory topic which I am giving it to you in the link, which I will suggest you if Sunday, which is a off day for all of you, try to finish it of that topic also. Then what happens, as I told you, in the month of June onwards, I will take only weekend. And in the weekend, I will try to cover up my 6 hours. So that even if there is an office scenario, so therefore it will not come in the way. This late night lectures will not come in the way. That is what I just want to tell you in your entire this thing. Okay, but the rest of the days of the week, students, again, you should have some target. Although you may not stretch up till 1 o'clock, but at least you should have some target, isn't it? That at least till 12 o'clock, say 10 to 12, So that 10 to 12 would be one very important point, students, in this context. No, maybe this till 31st only Ajita manage it. Because 31st only I'm taking this 10:30. After that, Saturdays and Sundays are only the 2 days I'm taking in the month of June. So in the month of June, what will happen? I told you, 3 hours, 6 hours. That's what my target is. And July, I'm done with everything. Everything. Huh? Try to attend live, students, because then your queries and everything would be factored in, and we will have a very great deliberation of the entire topic. Okay. So students, this is what it is. But my also last point, students, the most important point I think you have covered up or not, picked up or not. The other and the most important point which I've told you was about what, students? That by doing this, students, the other days in the month of June, 4 days, at least you people have your target of 2 hours at least daily of self-discipline, self-study. You need to have some target. You cannot go blind. See, I have the target, so I'm telling you that 31st I will have to finish off transfer pricing. That is my target for all of you. So similarly, something you should also plan for, say, from June, that 4 days or 5 days in the week that you people will have. So you should have your own targets for the same. You just cannot go blind. So 2 hours and 2.5 hours, do whatever it requires, but ensure to finish it off something tangible. Okay, take up a plan for 2 months, June and July, but at least cross the road. DT, the biggest subject, will get over in this particular manner. But one more subject or half 50% like elective, but you can think of it, which is an easier load. Do something and try to finish it off that, so that what happens if supposing June, July, DT is over, elective is also over. Can you think of what is going to happen now? Your mind is already now on a better side. So if you are appearing for, say, for example, one group, so those students who are appearing for one group, they will get eased out. Both those who are appearing for both the groups also, maybe then they will have to take up the extra load also for the other subjects as well. Planning is the key, students. At the end of the day, we need to know what we are doing it, and that exactly what we will be looking into it. Yeah, in Hindi, Ajita, I'm starting elective batch from 1st of international taxation. The elective batch I'm starting in Hindi, international taxation, from 1st of June. 1st of June. Okay, so that is the time, and that timing is in evening. Evening timing is, I think, 6:15 or 6:30, something like that. Okay, so that is the time. Evening 6:30, around that time. So that is the time which is there. So elective batch, 1.5 hours daily. So this would be the case. Okay, students. Now, students, over here, if you see, students, price hike. Can you see that? Price hike by 15% on May 31st. So any of your friends, students who are there and who wants to take up the subscription, please do let them know about it. Okay, that they can, and in fact, tell them that in the existing particular price, that they can take up the subscription and they use the code CADS, and they'll get 10% discount in the existing price. On or after 31st of May, it will enhance to 15%. So whatever is the existing subscription price, it will go up to 15%. So tell them, all your friends, students, those who have got their attempt, say November 22, May 23, November 23, to take this particular option now, and please do tell them to use this code of CADS so as to get this discount as well. Okay, students. So this is what it is, students, in this context. Now, students, any particular question that you will have, any even a general question which is there in this context, you can ask me in this context. What is the timing like? Is that Ramya? What is your elective? That you have taken? And what is the time? I think, Ajita, what's the time that you come in? My suggestion, Ajita, would still be FSCM. What is that? FSCM means financial. Okay, maybe. Ajita, do one thing then. Maybe you take up the recording part as your office is there, but you can use your time also. Financial service. Okay. So what you do, like the lecture timing, say for example, 6:15. I'm not 6:15 to 7:45. I think this is the time. So what you should do, Ajita, is that, like for example, you should try to catch up, say at 7:30. You come live 7:30. And supposingly of the previous session, if you have got any query, you should try to sort it out that query in the live lecture. This is the best thing that you can do. Are you getting this one? Any queries that you will have of the previous class, you should just try to spend the last 15 minutes and try to get your query resolved. So that at least you are also in the real time. Otherwise, if you see the recording, so there again the danger, you know the danger, the backlog will keep on increasing. So I think this would be the best particular strategy that you can also have. Okay. So students, just again, last particular thing, please do let your friend knows about this price hike thing, which is up to this one, and tell them to take up this particular subscription by 31st of May by using the code CADS, so that they can also get the discount of this 10%. Okay students, tomorrow night at 10:30 p.m. Lecture number 3 of the compiler series we are going to start, and equalization levy and transfer pricing with the topic that we are going to target. Equalization levy I'm going to link up with the TDS also, 194. So that would be all interlinked in the tomorrow session. See you then students. Take care. Good night to all of you. Bye-bye.